A lot of our clients have, been in business 30, 40 years. It could be second, third generation. We have clients that have been in business over 50 years. We have a client we're bidding on now that's been around for over 120 years. So I think legacy is extremely important. The culture you created, it's important for you, that a buyer coming in has that appreciation for what you have established, not only inside your company, but also inside your community. Hi, everybody. Welcome back to our podcast, Ins and Outs of Selling a Business. Today, we're going to continue our discussion from our last episode about the most important factors to get a deal to a letter of intent. Not to close, but to get a deal to a letter of intent. And we're looking to correlate that, with the types of buyers out there. And the reason we're kind of focusing a little bit on this is because I think it's important. We founded Osage back in 2001 when we felt our clients, typically family close-sale companies looking to sell, needed a higher level of service. And from our perspective, our model has been for 22 years is that the best way for our clients to maximize value is through a auction process. And we've talked about this in prior episodes, but from our auction process, our job, our goal is to bring you as business owners, multiple bidders to the table at the same time so you can make an informed decision on who's the best buyer that's the best fit for my company. Not only in price, but, overall value. And we talk about value, we're talking about obviously price, but more importantly, the legacy of your firm. A lot of our clients have, been in business 30, 40 years. It could be second, third generation. We have clients that have been in business over 50 years. We have a client we're bidding on now that's been around for over 120 years. So I think legacy is extremely important. The culture you created, it's important for you, that a buyer coming in has that appreciation for what you have established, not only inside your company, but also inside your community, right? It's important. You've been a big contributor, whether out there or behind the scenes within your community. And of course, your people, right? Your people got you are today. And it could be, a lot of our clients have had multiple families of employees that work with them as well. Their sons and daughters and grandkids have come to work with the same company. This has been their second home. So it's important for you. So getting things to the letter of intent stage with a buyer pool is understanding what factors fall into that is critical, because a lot of buyers are just not going to agree with your rationale behind it or how you've run your business. And they're going to, we like the business, but, or, we don't like the growth. So we talked about last episode, the number one upside growth potential. Hey, we like the business, but we really haven't grown enough. We don't see the growth opportunity, so we're going to take a pass. Your revenue consistency, not revenue readability or reoccurring, but just you've had some bumps. You were able to pivot during COVID, and you were able to do this with inventory buys or new products that related to COVID, or you name it. You were able to sidestep some of these supply chain issues that are bothering or inhibiting your competition from providing product to the customers. A lot of buyers just have not seen enough traction post-COVID to get comfortable. And then, of course, we talked about your EBITDA margins, right? Where are you historically? Where are your margin? What's your margin growth profile? What's your margin profile look like? And there's specific buyers that have a specific margin profile. We're looking for companies doing a minimum of $3 million EBITDA and 20% EBITDA margin. And if it's below that, they won't look at it. You got to remember, the buyer pool out there is out there fishing. They're trying to talk to as many people as possible. And so they have other, bankers like Osage that are, that are on distribution. They're sending them information. So they're weeding through multiple different deals around the country, maybe around the world. And if they find one thing they don't like, they're not going to move forward. So it's important to understand the buyer profile when you're going through getting to a letter of intent stage, And that's why you want to have a greater pool of buyers that you're talking to at the same time, so that the ones that are serious about your business will submit a letter of intent. They understand the growth, revenue, EBITDA, and then, they look at overall, the number 4 on the list is revenue, overall revenue growth, right? Not revenue consistency, but revenue growth. We have clients that have had a nice run, but, over the last 3 years have, maybe grown 3%, 5%, maybe 8%. And we have other clients that have gone from, 10% to 15% to 20% growth. So what is attributing to that growth? And digging deep into that. We talked a little bit about that on last episode. Is it because you just raised your prices because of inflation? It cost you $1. You used to sell it for $2. Now it costs you $1.20, but you're selling it for $3, right? Supply demand. And how you equate that and provide the support behind that is going to be interesting, because some buyers will drop off because they think you just grew your revenue based on price increases versus new customers, etc., new products, opening new territories, you name it. So when I look back at your last 12 months, they're going to say, okay, your revenues have gone up. How much is price increase? How much is, new customers or new products into customers? And what end markets are you serving? Right? That's a big one right now. What end markets do you serve? Well, why do they ask that? Well, for them, they're looking at all these industry reports, and you could be in pharmaceuticals or supply some product in pharmaceuticals, and that's a market that is growing substantially. Or you could be, supplying into the builder trade right now. Home sales are off, things are softening, interest rates are way up. So what's the sustainability of that market over the next, it's a cyclical market, housing, right? Even though we're short 3 to 4 million homes and condos and apartments in this country right now, builders aren't going to build, as much when, their cost of materials is up, interest rates are up, and they're going to sit back and wait for the things to tide to turn, possibly. So, how that revenue growth is a key factor, and how you explain how we present it to the buyer pool. Again, one buyer is no buyer. Certain buyers in and around your industry are going to understand how you're approaching it and buy into it, and others aren't. It's okay. They're not the right kind of buyer for you in the first place, because they're going to come in with a much lower valuation, most likely, and 2, they're just really never going to get there, because we're just talking about factors to get a deal to the letter of intent stage right now. Once you get to that letter of intent stage and go into due diligence, all these things we we're just talking about, and there's a list here. We're going to, we'll try to get through as much as possible, but growth, revenue consistency, EBITDA, revenue, and then overall revenue growth, right, are going to be looked at very closely by a number of consultants and professionals that the buyer is going to hire to opine on, agree to, or not. I mean, we have a deal right now where, the buyer is concerned about the technology of our client, that we haven't invested enough in technology. And they may not be the right buyer. We're talking to other people, of course, right? But their concern is what's the R&D investment going to be over the next 3 to 5 years? Now, no one does what this client does. They're have produced throughout COVID, sustainable increased revenues and increased profitability, but they're asking a question about, well, you need to make more investment in R&D. I said, well, of course we do, and we will moving forward. But today, we produced X revenue, X EBITDA historically, and we believe the valuation, should be a reflection of that. The future potential of that is something that we're going to work together with, or you're going to be able to grow with, based on what we have in the pipeline for new product development today, right? But you don't know what people are thinking of what turns people on, turns people off. We always say, no preconceived notions, who am I to judge? We don't know until we get into a conversations with multiple buyers. Again, multiple buyers at the table at the same time gives you a greater opportunity to understand where they're coming from, if you like them, and then whether you want to go to that next stage, letter of intent, and then move into due diligence. And then again, we're talking about this survey, that results of a survey from a number of professionals over last year in our field: merger acquisitions, investment banks, PE firms, business brokers, other professionals that work in the transaction area, merger and acquisition space. So number 5 on the list is interesting, because I think it's always asked. We do a Q&A session, with our potential buyers. They get a conversation with us. They get our memorandum on the business. It covers all this stuff that we're talking about in great detail. But they still ask the question, and we do a question and answer, and one of the questions is, what is your revenue from repeat customers or reoccurring revenue? So, which is a good question. I mean, if you're a company that, whether a service business or a manufacturing company, et cetera, and you have a consistent customer that's been a customer for several years, that basically is on a PO basis. They submit hey, we want to hire you for a 6-month contract, or we want to be, we want to put you on a subscription, and we want to pay you a monthly fee for the next 3 years to provide us IT services, or we want to buy this product and, we're going to issue a PO, right? But they've been a customer for a number of years. The buyer looks at that and says, from an importance perspective, it's a high level of importance to get a satisfactory answer back to a buyer pool. Now, again, depending on the buyer, it depends on how much they're comfortable with your answer and how you run your business. And again, if it turns out that they don't have that high comfort level, they may fall off out of the bidding process, out of our auction process, and not be one of the parties that gets a seat at the table to meet with you. So, in looking at that, there's a lot of ways to, kind of break that down from our perspective. And a lot has to do with that kind of stickiness factor you have with your client, right? Specifically in manufacturing, as you relate to, aerospace, medical, things like that, where you need to be qualified. And what we see a lot with our clients is that the larger, tier 1 suppliers, whether it be a Siemens or a Honeywell or a Pratt & Whitney or a GE, they place a lot of reliance on their supplier base, on your internal engineering and quality people, to provide the service needed to get the product out the door. So, and sometimes you're actually in their systems, right? You're actually physically, day to day, in their systems, monitoring inventory levels, so you can actually produce the product to meet their high and low standards, what they need. It's very common these days. So if you have that kind of deep stickiness factor, your customer's not going to want to move the product. You may be sole sourced in this product, right? Or you may be one of 2 parties that produce it, but you're the preferred vendor, and they have another party because they have to have a backup supply. But for them to move that part or assembly or whatever out of your business is a huge undertaking and huge cost for them. And it's not going to happen overnight. So, that repeatability of business, reoccurring business, that's with software and MS, managed service providers on the technology space. You have a 3-year contract. We charge you X per month, or it's a licensing deal. That's one thing. But when you have a product that you're selling, that you've been doing this for years and years under a either long-term agreement with your customer or even on a PO basis, how you answer that question and how buyers perceive that is important. And so we talk about that stickiness factor during conversations we have with potential buyers. We talk about that stickiness factor with our clients. We talk about that stickiness factor during management presentations when they do get a seat at the table. And the question is, are they comfortable with that or not? Again, there's a lot of people out there right now. There's a lot still, even though we're in a market which is, from a lot of people's perspective, quote unquote, uncertain, there's a ton of money out there. And so buyers are out there, trying to engage in conversations, as whether they're doing it in good faith or doing it just to get business, just to have a conversation, just to meet their quotas that I need to talk to 25 business owners this week or whatever, right? It doesn't matter. Your phones are ringing, you're getting emails, you're getting letters. Hey, we want to buy your business. Or we have someone interested in buying your business. I mean, I'm getting it myself. I got someone dropped me through our contact form last night. Hey, we got buyers for your business, and we've sold X amount of companies. Who are these buyers? You don't know who they are, right? So are you, as an analogy, what's the phrase a buddy of mine told me once? He says, are you going to get in a car with someone you don't know to drive you to one of the most important decisions in your life, not knowing how you're going to get there? Or are you going to take control of the situation? And you're going to drive the process, or have Osage or someone like Osage drive the process on your terms to get to where you want to go based on what your goals and objectives are. And so when you look at these things that we're going through here with the buyer getting to an LOI, a lot of buyers are going to fall off the wayside. And if you're engaged one-on-one with one buyer, as we say, one buyer is no buyer, and we'll continue to say that phrase because we truly believe it, you need to test the market, to get the best value that's the right fit for you. I mean, you're at the 1 yard line. You've had your company 20, 30, 40, 50 years or more, first, second, third, fourth generation in some cases. You owe it to yourself to make that investment in the time and hiring someone like Osage and a good team to get you over the goal line, to get the deal done that works for you and your family. So all these things we're talking about, just get to LOI stage, you're going to find a lot of buyers kind of fall off the wayside because they don't have a comfort level for whatever reason. I mean, the next one on the list is, strengthen your management team. And it's really important factor, right? I mean, if you're owner of a business and you're head of sales and you're head of production and you kind of run everything, a buyer coming in, hey, you have your secret sauce. You've done 15, 20 million a year. You've done 3, 4 million EBITDA, whatever the number, million, whatever the number is. But what happens if you walk away, right? The answer is almost every company is going to want to have some kind of transitional period. And depending on the buyer, it may be 6 to 12 months. Say it's a strategic buyer, a corporate buyer, someone that's in your space, that's got a national sales director. They have regional sales directors. They have territorial sales managers, and they have salespeople. They're not so concerned about you have one or two people that are in sales, including yourself, versus maybe a private equity firm that's trying to get into your business. They come to you and say, oh, you're doing 4 million EBITDA and you're doing 20 million. You're right in our strike zone. We love this business. But when they get into it and start having a conversation with you, they realize that there's only one or two people that are really key to driving that profitability. They're either going to walk away or they're going to tie you into the deal. Meaning that they're going to ask you to participate, roll equity, stay with them, help grow it, and you're going to run your own business, again, with them as a partner. And that may be great. We have a number of clients that love that concept, to grow it. Second bite of the apple really works for them. It's a terrific way to take some money off the table and diversify your portfolio, take care of your family, and then you grow it for the next 3 to 5 years and you sell out with them and you get another payday. We have a lot of clients that don't want to do that. I'm 70 years old. I don't want to work another 3 to 4 years. I've been through the gauntlet over the last 3 to 4 years, and I'm tired. I'm ready to make that move. So engaging one-on-one with a buyer like that is not going to get you where you want to go because of the fact that they need you, right? And you don't want to be there. for long term. I mean, everybody has to go a transition period. It could be 1 or 2 years. But the fact that they want you to reinvest in that business is not something you want to do. So having that conversation with them, spending maybe a couple of weeks, you get them information, you go through this, you go through that, everything, you're stressed out, you're trying to keep it close to the vest because you don't want people to know. Anxieties are up, and then all of a sudden you just think, oh, well, you meet the profile, but your management team is too weak, right? That's not the kind of buyer for you. That's why we do what we do. That's why we run our process. That's why we go out to multiple parties, because these type of buyers are going to fall off. We have a deal right now where we got a number of bids. We do a bid process first to see what the value range are, and then based on the bids, we sit with our client, invite them to the table to management meetings. We specifically said in our book, and we always have a section on ownership transition goals and objectives. Our client wants to work under a mutually agreeable 2-year employment agreement and then retire. He's 68. One of the bidders came back and wants him to roll 30% equity. It's like, and we went back. He's not rolling 30% equity. It's not. Can you restructure it in a different way? And he may make a minor investment in the business, but not at 30%. It's just not something that he's prepared to do. And we explain that to you, not only in our book that we put out, but also in the question and answer document. We have a section, ownership transition goals and objectives. And we specifically said what his objectives were. But, the buyer came to the table looking for an equity roll. Now, granted, going through a process, depending on the age of our client, depending on their desires, long-term goals, they may change during a process. You know what? I kind of like this. Maybe I'll do that. But in this case, no. So if you were engaged with someone, you met everything on the financials met the profile, but they need you to stay on, you spend a lot of time on something that's, stressed you out and it's not going to get you anywhere, and you got to restart the whole process again. So you got to be concerned. So getting to LOI stage, understanding these things is really critical. There's a number of other factors, and I'll just kind of run through them that kind of in this survey. Dealing with low customer concentration, always an issue. Your brand, your reputation in the marketplace. If you're, depending on your product, it may not come up unless you're a consumer product and you actually have a product you sell with your branded product. But if you don't, your brand recognition is going to come up anyway in due diligence. The buyers are going to spend a lot of time in what I call, your customer's happy. Keep it like that. So, how much time are you willing to stay post-closing? Things that had minor input like the location, geographic footprint. Most buyers, it's not a major concern. And then, of course, depending on the kind of product you make, do you own the IP, your patents, things like that? If you are producing a product or assembly or machining a piece, or you're in the, you're a service provider, it may not, that may not be critical. If you're a biotech company or a pharma company, that may be very important. So in closing, I think it's important to really test the market, because getting to the LOI stage is going to be dependent on a number of factors. And the buyer profile is going to determine who and who not is going to step up and get your business and submit that letter of intent. And based on the letter of intent, is that something that's workable to you to go to the next step into due diligence and closing? So I want to thank you today again for being with us for our podcast. Again, my name is Keith D. I'm president, founder of Osage Advisors. We are a boutique merger and acquisition firm working with business owners and their families with revenues of $5 million and up, looking to sell. This is our 22nd year in business. You can reach us at our website at osageadvisors.com. Feel free to email me at kdee@osageadvisors.com, or pick up the phone and give me a call at 860-767-3273, extension 1001. Thanks again for joining us today, and have a great day.